Thank you for joining me again today. I'm Ivan Illan, the founder and Chief Investment Officer for Align Wealth Advisors Investment Management. And there's been a lot of news lately, as you probably have heard and gathered, particularly around the banking sector and the implications, obviously, for the broader economy. So I'm going to touch on those a little bit today in this video, and hopefully you'll have a little bit more insight into really what triggered this whole issue. So, from our perspective, this crisis, if you will, was really the impetus for it was this designation between available for sale assets that a bank holds versus hold to maturity assets that a bank holds. And so when a certain amount of redemption requests or depositors are making their requests from the bank to withdraw assets, the bank has to move their reserve holdings from a hold to maturity status, because they owned a bunch of treasuries, long-dated treasuries in particular, actually mortgage-backed securities in the case of SVB. And so those, it's an accounting thing essentially that happens. So it goes from the hold to maturity status to available for sale status. And so once that designation change happens within their accounting for their assets and their reserves, or some portion of it, that's when it impacts the income statement. And so booking those treasuries as available for sale creates a big negative income impact with the company. And so that was the impetus for them to go out and start looking for some way out of this. And of course the federal government has come in and essentially created a backstop situation for this bank that is very peculiar, in that $250,000 for individual registrants who have money on deposit and $500,000 for joint accounts is the stated and very well known insured amount. And so to really ignore that and backstop now 100% of those deposits, I think becomes a bit strange, because now it's an aberration in the banking system, and there are some banks that do not have 100% fully insured deposits, and there are now other banks that have been backstopped that do have 100% fully insured deposits. And this is a dichotomy that is not healthy for the banking system. So we would expect that there will continue to be some volatility as this issue gets settled. Anecdotally, and just for clients who are watching this, who are in our investment advisory solutions, we did sell U.S. financials back in October of 2022. And part of that was in preparation for essentially what we believe was better interest rates environments in general in terms of fixed income. And one of our primary reasons for holding financials in general was because it was an excellent source of cash flow into the portfolios for a period of time when interest rates were at 0.5%, 1%, 1.5%. And so last year, we remained very, very much on the short end of the yield curve, buying very short-term treasuries and other types of high-quality bonds, which certainly was one of the main factors in why we had outperformed our benchmark so significantly in 2022. But as we got close to the end of 22, we saw that there were plenty of opportunities to allocate into fixed income markets at significantly better interest rates than we had seen for well over a decade. So we sold U.S. financials at that time, and then even this past Monday, we sold our European financial holdings, and we're happy we did that, because certainly the way this week has played out it isn't too surprising. Now, obviously, regulators all over the world, whether it's in Europe, here in the U.S., everyone is now very concerned and looking at their balance sheets and trying to understand how this kind of supervisory oversight could actually happen. But it isn't, too much of a surprise when bond yields go up so significantly, and the Fed has been in a rate hiking cycle. It's absolutely a natural and normal thing that bond prices decline. And so all of these banks are holding bonds that are significantly below par value, and because those yields have come up so much. So it really isn't exactly what we would term as a black swan event. It's very highly predictable that prices and rates and yields, they move inversely to one another. So it isn't a surprise. Even the Chair Powell, in one of his testimonies last year, said that they're going to keep going until something breaks in the economy. Well, something's now broken, and maybe that gives them an opportunity to pause in their rate hiking. Certainly, the markets believe that there's going to be somewhat of a pause, and there may very well be, but from our standpoint, quantitative tightening is still happening. The Fed is still allowing many tens of billions of dollars per month to roll off their balance sheet, which is also part of this mopping up of liquidity in the economy. And so bank failures factor into the mopping up of liquidity in the economy. And so keep that in mind as we go forward. That's certainly something that we're keeping front of mind. We have made plenty of preparations in our portfolios accordingly. If you have any questions about what we're doing specifically, please don't hesitate to reach out to us. You can call us at 310-795-0622 or send us an email at info@alignwealthllc.com or visit our website at alignwealth.com. Thank you so much.